California homeowners just got hit with a 36% insurance rate increase. Not over 5 years. For 2026. And that's just the state backup plan. The actual market's looking at 40 to 50% jumps across the board. We're 1 year past the LA fires that ripped through Southern California in January 2025, and the insurance market isn't recovering. It's collapsing in real time. $22.4 billion in insured losses. That number came out recently, and it's higher than anyone projected 12 months ago. Higher than the 2018 Camp Fire. Higher than what actuaries built their models around. The original estimates sat around $20 billion, which already sent insurance stocks tumbling last January. Then the claims kept coming. Delayed filings, business interruption costs, additional living expenses for families still displaced, it all stacked up. And now insurers are looking at their California books and realizing they've been underpricing risk for years. The fires started January 7, 2025. Extreme weather, the kind meteorologists flagged days in advance but couldn't fully predict the scale of. Santa Ana winds pushed flames through canyons and residential areas faster than evacuation orders could process. Thousands of homes gone within the first 72 hours. San Gabriel Mountains, Malibu, parts of LA County that hadn't seen fire behavior like this in recorded history. Not because fires knew it's not, but because the intensity and speed exceeded what infrastructure was built to handle. Here's where the insurance angle gets messy. California's homeowners insurance market was already fragile before any of this happened. We're talking about a $15 billion market that had been shedding policies in high-risk areas for years. Insurers were quietly non-renewing coverage in wildfire zones, not making headlines about it, just letting policies lapse when they came up for renewal. By September 2024, the state's FAIR Plan, which is basically the insurer of last resort when no private company will touch you, had grown to 451,000 homeowner policies. That's a 123% increase over just a few years. Then the fires hit. And suddenly those 451,000 policies weren't enough. More homeowners got dropped. More couldn't find coverage. The FAIR Plan became the only option for entire zip codes. And unlike private insurers who can spread risk across multiple states, the FAIR Plan is California only. Every massive loss hits the same fund. There's no geographic diversification to soften the blow. The math stopped working. The FAIR Plan wasn't designed to handle $22.4 billion in claims. It wasn't designed to be the primary insurer for 500,000 homes. So they did what any struggling insurance fund does. They raised rates. That 36% average increase for 2026 isn't just covering the LA fires. It's recalibrating for the reality that California's risk profile has fundamentally changed. Insurers are looking at climate data, fire behavior models, and historical burn patterns and concluding that what happened in January 2025 isn't an outlier. It's the new baseline. Private insurers are pushing even higher. That 40 to 50% range across the state isn't uniform. Some areas are seeing doubles. If you're in a high-risk zone, your renewal notice this year might show a premium that's literally twice what you paid in 2024. And that's if you get a renewal at all. Because the other option insurers are taking is just walking away entirely. Non-renewals have been the quiet crisis underneath all of this. People who've had coverage for 20 years getting letters that say, essentially, we're done underwriting wildfire risk in your area. The state tried to pump the brakes. On January 9, 2025, 2 days after the fires started, officials issued a 1-year moratorium on cancellations and non-renewals in affected Southern California areas. Basically told insurers they couldn't drop policies for 12 months. That moratorium protected thousands of homeowners through 2025, but it's expiring now, early 2026. And the expectation among policy analysts is that we're about to see a wave of non-renewals that makes the last few years look minor. That's the panic scenario that keeps getting mentioned in industry reports. Not that rates go up, they're already up. But that coverage becomes unavailable at any price in certain areas. Insurance deserts. Places where the only option is the FAIR Plan, which is already underwater trying to cover losses from last year. If another major fire season hits in 2026, and the FAIR plan is still processing claims from 2025, the whole system could just break down. Not theoretically. Actually break down. Property values are already responding. Buyers are avoiding high-risk zones, not because they don't want to live there, but because securing a mortgage without proof of insurance is nearly impossible. And when insurance is either unavailable or costs $5,000 plus annually just for basic coverage, the economics of homeownership stop making sense. Real estate data from late 2025 shows price drops in exposed areas, which creates this feedback loop. Lower property values mean lower tax revenue for local governments, which means less funding for fire prevention and emergency services, which means higher risk, which means even fewer insurers willing to write policies. Some homeowners are getting forced into tough decisions. Take out a second mortgage to cover premium increases. Sell and move to a lower-risk area, probably at a loss. Or roll the dice uninsured, which is technically illegal if you have a mortgage but practically unenforceable until something goes wrong. Anecdotal reports from insurance brokers in LA County suggest a growing number of people are choosing that third option, gambling that they'll be fine for a year or two until the market stabilizes. But markets don't stabilize when the underlying risk keeps increasing. The response from state officials has been a mix of emergency measures and longer-term reform attempts. September 2025 saw an executive order that called for a whole-of-government approach to the insurance crisis, which sounds impressive but practically meant coordinating different agencies to figure out how to keep the market from imploding completely. There's been a push to expand coverage options, cut costs where possible, streamline mitigation programs that help homeowners reduce fire risk and potentially lower premiums. In October 2025, Assembly Bill 226 got signed into law. That's the one allowing the FAIR plan to secure loans and bonds to cover massive claims, basically giving them access to more capital so they don't run dry mid-crisis. Other legislation in the works aims at requiring insurers to give more advance notice before non-renewing policies, or creating incentives for companies to stay in the California market. But none of this changes the fundamental problem, which is that wildfire risk is increasing faster than the insurance industry can adapt. By November 2025, backlash was escalating. Fire victims started publicly calling for the resignation of Insurance Commissioner Ricardo Lara over controversial reforms that some argued made the situation worse, or at least didn't make it better fast enough. There's this tension between what policymakers can actually do versus what desperate homeowners need them to do. Lara's office has disputed some of the rate increase figures, arguing that the 40 to 50% statewide average is exaggerated, that it's more localized. But if you're the homeowner getting that renewal notice, the statewide average doesn't matter. Your rate matters. January 6, 2026, one day before the one-year anniversary of the fires, a housing push got announced specifically aimed at keeping fire survivors in their communities rather than forcing them to relocate due to insurance costs. The California Safe Homes Act launched around the same time, focused on wildfire mitigation efforts. The theory is that if enough homes get retrofitted with fire-resistant materials, defensible space around properties gets maintained, and community-level prevention improves, then insurers will see reduced risk and potentially stabilize rates. That's a multi-year project though. It doesn't help anyone facing a 50% increase right now. The national insurance market is watching this closely. So far, major insurers haven't seen credit rating downgrades from the LA fire losses, but analysts have flagged California exposure as a risk factor in recent reports. If this pattern continues, if every major fire season produces $20 billion plus insured losses, then it's not just a California problem. Reinsurance rates could spike globally, which would push up premiums in other disaster-prone states. Florida's already dealing with a similar crisis around hurricane risk. Louisiana has the same issue. The Gulf Coast, the wildfire corridor along the west, even parts of the Midwest seeing increased tornado activity, they're all vulnerable to the same market dynamics. What's wild is how predictable this was. Industry reports from 2020 and 2021 were already flagging California's insurance market as unsustainable. Climate scientists were publishing data showing increased fire risk. Local officials in high-risk counties were sounding alarms about policy non-renewals. But there's a gap between knowing something's coming and actually preparing for it, especially when preparation requires legislative action, regulatory changes, and billions in infrastructure investment that nobody wants to fund until disaster forces the issue. Now we're in the forcing function. The disaster happened. The bills are coming due. And the solutions being proposed, mitigation grants, fair plan expansions, regulatory reforms, they're all playing catch-up to a crisis that's already here. Some homeowners in LA County reported seeing their premiums double between their 2024 and 2026 renewals. That's not sustainable for middle-class families. It's barely sustainable for upper-middle-class families. And it's creating this weird sorting effect where only the wealthy can afford to live in certain areas, not because of housing costs but because of insurance costs. There's talk of lawsuits. Class actions from homeowners arguing that insurers engaged in bad faith practices by underpricing risk for years, collecting premiums based on inaccurate models, then suddenly bailing when claims came in. Those cases will take years to resolve, and even if homeowners win, the money won't show up in time to help with 2026 renewals. There's also the federal aid question. Does California get disaster relief that includes insurance market stabilization? Does Congress step in with some kind of backstop program like they did for terrorism risk after September 11th? As of early 2026, those conversations are happening but nothing concrete has emerged. The timing matters here. We're heading into another fire season. Summer 2026. If conditions are similar to 2025, dry winter, late rains, strong Santa Ana wind events, then another major fire isn't unlikely. It's probable. And if that happens while the insurance market is still absorbing $22.4 billion in losses from last year, while the FAIR Plan is operating at capacity, while private insurers are actively exiting the state, then you're looking at a genuine market collapse. Not a crisis that gets managed, but a system failure. What can homeowners actually do right now? Check your policy before renewal hits. If you're in a high-risk area and you haven't received a non-renewal notice yet, don't assume you're safe. Start shopping around, even though options are limited. Look into mitigation grants. California has programs that fund things like fire-resistant roofing or defensible space clearing, and those upgrades can sometimes lower premiums or at least make you more attractive to insurers. If you get non-renewed, the FAIR Plan is your fallback, but apply early because processing times are longer now with increased volume. Some people are forming buying groups, essentially pooling resources with neighbors to negotiate better rates or bring in smaller regional insurers who might be willing to write policies for a whole community at once. That's not common yet, but insurance brokers are starting to explore creative solutions because the traditional market isn't functioning. There's also the option of self-insuring if you own your home outright, though that's a massive financial risk that only makes sense if you've got serious capital reserves. The bigger question is what this means for California long-term. If insurance becomes unavailable or unaffordable in large portions of the state, does that reshape population distribution? Do we see migration away from wildfire zones toward urban centers or out of state entirely? The rate increases are happening now. So homeowners are stuck managing an immediate crisis while waiting for systemic solutions that may or may not arrive in time to matter. It's a brutal position to be in, especially for people who bought homes years ago when insurance was affordable and reliable, and who now face the choice between financial strain or walking away from property they've invested in. What's your situation looking like? Are you seeing massive rate increases on your renewal, or has your area stayed relatively stable? Drop a comment if you've dealt with non-renewals or had to switch to the FAIR Plan. It'd be useful to hear how that process actually went for people. And if this kind of finance breakdown is helpful, subscribe because we're tracking how this develops through 2026. There's a lot still unfolding here, and it's not slowing down anytime soon.